Welcome to TalkTickers, your shortcut to being well-informed. Today, we're taking a deep dive into 3M's recent second quarter earnings call. That was held Friday, July 18th, 2025.
Right, and we're really going to unpack how this huge industrial conglomerate is handling things in a pretty complex global scene.
Exactly, and maybe see if this reinvention story they're telling, if it's really taking hold despite some, ongoing challenges. So let's kick things off with the headline numbers for Q2 2025.
Okay.
Adjusted earnings per share, $2.16. That's a solid 12% jump year over year.
And definitely above what the street was expecting.
Yeah, nice beat. Organic sales growth, positive too, at 1.5%.
And that's what, the third quarter in a row, all three business groups saw growth?
That's right. Consistency there.
Yeah.
Operating margins also saw a big expansion, up 290 basis points.
Wow, yeah. Reaching 24.5%. That's quite strong.
And cash flow. Free cash flow looks solid, $1.3 billion.
With that really impressive 110% conversion rate, that definitely stands out.
It really does.
And what's interesting, like you said, is how they pulled off these strong numbers when management themselves kept saying the macro environment is sluggish and moving laterally.
Right. Seems like they're focusing inward.
Exactly. It points to, real internal efforts driving things, not just riding economic wave. That 110% conversion, for instance, making $1.10 in cash for every dollar of net income, that screams efficiency.
Okay, those numbers definitely pop, especially with that sluggish backdrop. So what specifically fueled this outperformance? Were there particular engines?
Yeah, there were, four main things driving the earnings beat. First was just continued efficiency in G&A.
Like IT optimization and stuff.
Exactly. IT optimization, lower indirect costs.
Right.
Second, they were more, let's say, measured in their year-over-year investments.
Responding to lower demand and tariff.
Precisely. Third, the weaker U.S. dollar actually gave them a bit of a tailwind.
Ah, the FX benefit.
And finally, they had a 6-cent boost from selling an investment in Q2. That was something they originally thought would hit in Q3.
Okay, so a timing thing helped too.
Right. And operationally, you saw a big, $300 million benefit from volume growth, productivity across the board, lower restructuring costs, even some equity comp timing.
When it wasn't all smooth sailing.
No, that was offset partly by $50 million in growth investments and about a $25 million hit from tariffs and those stranded costs from divestitures.
Okay, so with those strong results, how do they deploy capital? What did that look like for shareholders and future growth?
Well, they sent $400 million back to shareholders through dividends, keeping that consistent return going.
Always good to see.
And they were active with buybacks, too. $1 billion in gross share repurchases in Q2.
Which brings the total for the first half?
To $2.2 billion. And they said they'll stay opportunistic on buybacks in the second half.
Meaning they'll buy if the price looks right, but they're not locking themselves in.
Exactly. They want to keep that balance sheet flexible. It's about balancing those returns with being ready for anything, strategically speaking.
Right. So management talks about building a culture of excellence. What does that actually mean on the ground? Let's start with innovation.
Okay, yeah. Priority 1, innovation excellence. And what's really interesting here isn't just, saying innovation, it's the actual cadence.
They're launching stuff faster.
Significantly faster. 64 new products just in Q2. That's up around 70% from last year.
Wow. So they're on track for their yearly target.
Easily. Should beat their goal of 215 for the year. And crucially, the sales from products launched in the last 5 years, that metric bottomed out last year.
But it's recovering now.
Recovering and accelerating, up 9% in the first half, and it picked up speed in Q2. They think it'll be up over 15% for the full year.
And these aren't just minor tweaks.
No, some are quite specialized, like a new low-profile air pack for firefighters, and some clever consumer stuff around their Filtry platform.
Oh, yeah?
Yeah, one product has a reusable filter frame, kind of like a razor and razor blade model.
Ah, smart. Cuts down shipping, saves shelf space, gets recurring buys.
Exactly. And they're backing this up with investment, too, adding about 150 R&D folks since Q4 last year. So it feels like a real commitment.
Okay, so the pipeline's filling up, but getting those products sold effectively is key, right? What about commercial excellence? Is that actually moving the needle?
It seems to be, yeah. Commercial excellence is all about boosting the sales team's performance, finding those cross-selling chances between divisions, getting better on pricing, and keeping customers from leaving.
And they started this where?
The Safety and Industrial Group, SIB, Kicked it off in the US late last year. Now it's rolling out in Europe and Asia.
Seeing results yet?
Early days, but yes.
Yeah.
They've trained over 400 sales managers. They're seeing more deals getting closed, better order rates. Average daily orders in SIBRA are up low single digits in Q2.
And the cross-selling.
They've identified 48 specific pairs of products that can be sold together, double what they had in Q1. The pipeline for that is over $60 million, and they've already booked $10 million in new orders from it.
Okay, that's tangible. What about pricing?
They're tightening controls there too, fewer exceptions, focusing on bigger deals, seeing good progress, especially on the industrial side.
And this model is spreading.
Yeah, they're taking this enterprise-wide approach now to other groups, like transportation and electronics, TBG. Seems like a scalable plan.
So, innovation pipeline full, commercial teams executing.
Yeah.
How are the actual factory floors and supply chains running? That's operational excellence, right?
Exactly. Their third big priority. And they've made some pretty impressive gains here.
Like that.
Service levels. Their OTIF metric, on time and in full delivery, hit 89.6%.
That sounds high.
It's the best quarter in almost 6 years. They actually ended June just over 90%.
Nice. Consistent across the board.
Well, consumer and TBG are usually above 90%, but the big improvement was SIB, up over 300 basis points to 83%. They're closing that gap.
Okay. What about factory efficiency?
OEE overall equipment effectiveness was around 59%. Still room to grow, but it's improving, and it's letting them find ways to consolidate.
Can you give an example?
Yeah, they improved OEE by 12 points on a big adhesive coater machine in Iowa. That freed up so much capacity they could actually retire 2 really old, like 70-year-old coders at another plant.
That's a great example. Efficiency directly leading to cost savings.
Exactly. And quality costs are down too. Cost of support quality was 6.1%, down 90 basis points year over year. They're using AI models now to help optimize machine settings.
So all these operational tweaks add up.
Big time. They expect about $500 million in productivity gains for the whole year from all this, split between G&A and the supply chain.
Those operational gains sound really positive. But let's talk about the elephant in the room. Those legal liabilities, PFAS specifically.
Right. It's always part of the conversation with 3M.
The New Jersey settlement seemed like a step forward, maybe, but there are still a lot of other cases out there. How big is that remaining risk?
That's the critical question, isn't it? So back in May, they settled with New Jersey on PFAS claims, covered site-specific stuff and statewide claims.
Offering broader protection.
Yeah, broad protection against future suits from the state. And crucially, the payments are spread out over 25 years. All the way to 2050.
So manageable chunks over a long time.
That's the idea. And it provides a potential template, maybe, for handling the other cases, a predictable long-term structure instead of a huge upfront hit.
But there's still, over 30 other state AG cases, plus federal and international stuff.
Correct. That's still being managed. And it's worth remembering they are getting out of PFAS manufacturing completely by the end of this year.
Limits future exposure, at least.
Right. But yeah, the New Jersey deal is a positive signal, but it doesn't resolve everything. There's a key personal injury bellwether trial scheduled for October 20th.
So that will be important to watch. Could set a precedent.
Could definitely shape expectations, yeah, for settlements or further litigation.
Okay. So given the strong Q2, the initiatives, the legal backdrop, how did management update their forecast for the full year?
Well, building on that strong first half and kind of baking in the tariff situation, they raised the full year adjusted earnings guidance.
To what range?
$7.75 to $8 per share. That's a 13-cent bump at the midpoint.
And what's driving that increase?
Mostly operational improvements that accounts for about 23 cents, but it's offset by about 10 cents from FX and tariffs.
So net positive from operations and organic growth forecast.
They now expect that to be around 2% for the year, and free cash flow conversion still expected above 100%.
Still very strong cash generation then. What about the tariff impact they were worried about earlier?
They actually revised that down quite a bit. The gross headwind is now expected to be 20 cents for the year, down from 60 cents.
Why the big change?
Mainly because China tariff rates came down. And they're managing it too. About half the remaining impact is being offset by cost savings and sourcing changes, the other half by price increases.
Okay, makes sense.
Yeah.
And how are they seeing the wider economy playing out in the second half? Still sluggish.
Yeah, the view is still pretty cautious. Sluggish, moving laterally. They see IPI around 2%, GDP mid-2s, PMI still below 50. Generally soft.
Any specific markets showing signs of life or weakness?
Well, they think the safety and general industrial businesses are starting to pick up, and they credit their own commercial initiatives for that.
Okay, self-help kicking in there.
Right. Auto, they expect to be kind of flattish in the second half. That's actually better than the decline they saw in the first half.
Even with global auto builds being weak?
Yeah, they think it's mostly share gains on new car models driving that. Consumer electronics might soften a bit, and auto aftermarket plus general consumer probably stay challenged because U.S. retail is still pretty subdued.
Geographically, any standouts?
China actually did better than they expected in the first half, up mid-single digits, though they think it might slow down a bit now. Europe was flat, but maybe some signs of life outside of auto.
And order trends overall?
Modestly up in Q2. Backlog grew sequentially, covers about 20-25% of Q3 sales. And importantly, they didn't see any big tariff pre-buying, suggesting it's organic demand.
Okay, so putting all those moving parts together, what's the story for earnings and margins in the back half? Will Q3 and Q4 look like Q2?
Not quite as strong on the margin front. Historically, Q3 is usually stronger than Q4 seasonally. But for the second half overall, they're guiding margins around 22.5%.
Down from 24% in the first half. Why the dip?
Couple of reasons. The tariff impact hits harder in the second half, over 120, maybe 130 basis points. Those stranded costs from divestitures also pick up, going from $30 million in H1 to $70 million in H2.
Hitting that $100 million total for the year.
Exactly. And they're also planning for increased investments. But, and this is important, even with those headwinds, second half margins are still projected to be up 110 basis points compared to last year.
So still showing year-over-year improvement despite the pressures.
Right. They're absorbing those costs and still improving profitability.
So if you had to boil it down, what's the single biggest takeaway from this quarter about 3M's transformation? Is it the operational discipline, the innovation, the legal stuff? What really defines their path right now?
I think the core story here is really that pivot to self-help. They're showing a real focus on what they can control inside the company.
Rigorous efficiency, targeted innovation.
Exactly. Proving that even a mature, giant industrial company can drive real improvements in profit and growth when the outside economy isn't helping much.
And the PFAS settlement.
The New Jersey one is key. Not just for managing the liability itself, but because if it sets a pattern, it could start to lift that legal cloud. It might free up management focus and maybe investor perception to really see the operational and commercial changes underneath, moving past that constant legal overhang narrative.
Focusing on what they can control and executing.
That's the crux of it, yeah.
Okay, time for our disclaimer. Just a quick reminder. The following is purely for informational and entertainment purposes. It is absolutely not financial advice. Always, always do your own research and due diligence. That said, let's hear that outrageous but plausible trade idea for 3M.
Okay, so here's the thesis. The market, I think, is still heavily discounting 3M because of those legal liabilities. They're persistent, yes, but maybe becoming more quantifiable now, and perhaps overlooking this deep internal transformation that's happening.
So the trade is?
The outrageous but plausible idea is you go long 3M. You're essentially betting on a pretty rapid re-rating of the stock.
What triggers that re-rating?
Two main catalysts, potentially. First, more clarity on PFAS. Maybe that New Jersey settlement does become a kind of cookie-cutter framework for the rest, making the total liability feel more manageable, less existential, removes that overhang.
Okay, de-risking the legal side.
Right. And second, the internal stuff really starts to shine through undeniably. That accelerating new product growth combined with the operational and commercial excellence wins we talked about, you see it really boosting margins and growth visibly.
So long 3M, betting on those two things clicking. Any other part to this potentially outrageous trade?
Well, to make it a bit more of a focused bet, you could potentially couple that long 3M position with a short position.
Shorting what?
Maybe a competitor, a less diversified, older industrial company that's more directly exposed to some of the weaker spots right now, like that challenged auto aftermarket or consumer retail, without 3M's diversification or internal momentum. So you're betting on a widening gap. 3M pulls ahead on its self-help story while the other lags.
Exactly. You're playing the divergence, banking on that internal transformation at 3M really taking hold and being recognized, while others might struggle more with the current macro environment. Outrageous, but plausible if things break right.
Got it. So let's recap the quarter quickly. 3M delivered surprisingly strong Q2 results.
Yeah, driven largely by that focused execution on innovation, commercial improvements, and operational efficiency.
Which led them to raise their full-year guidance, even while navigating a pretty sluggish global economy.
And actively managing those significant legal liabilities with what looks like a clear, disciplined strategy.
Okay.
Which really brings up a key question for you, the listener, to think about. Just how effectively can a huge century-old company like 3M pull off this kind of deep internal transformation while juggling massive legacy issues like PFAS? And what does their specific journey tell us about the kind of resilience and adaptability needed to thrive in today's market? Something to chew on. We certainly hope this deep dive into 3M's earnings call has given you some valuable insights.
Yeah, food for thought.
We definitely encourage you to keep exploring these themes and, of course, form your own conclusions. Thanks for tuning in to Talk Tickers.